Welcome to Top M&A Entrepreneurs. Today, my guest is Sean Smith. This is a little bit of a different show because I'm talking to Sean Smith, who just started a search fund. It's called searchfundventures.co. Sean's got a partner, Nick Bryant. They're both on LinkedIn, and we're going to talk about how he started this search fund, why he did it, and what the progress is so far, and a little bit more about search funds. So, welcome to the show, Sean.
Thanks so much, John. And I'll just a quick little kind of caveat there. We invest into search funds, particularly self-funded searchers. So I wouldn't call ourselves a search fund as much as a investor into searchers.
Okay. So let's get down to the particulars of that, what that actually means. So who do you invest in and where do you find them? What's that buy box look like? And the process and how much you invest.
Yeah. So we invest into I would break it down into two different personas. There's your self-funded searcher, which a lot of people think of as, an individual who's a hungry entrepreneur who is going out to find a business that's probably between $500K and, $2 million in EBITDA. And they're buying that business using a mix of SBA loan and their own capital, and then in certain cases, investors' capital like ours. So that's the one persona. The second persona is kind of your independent sponsor who's probably, relatively new as an independent sponsor, not kind of the more experienced folks who have 10 deals or under their belt and are doing, $10 million EBITDA acquisitions. These are folks who it's maybe their first or second deal, and the size of the company is, call it 1 to 3 million in EBITDA or so. So that's kind of the two groups of people we focus on. We find folks through, a mix of inbound deal flow. We've been more and more vocal on communities, both digitally and going to be kind of participating in some of the upcoming conferences. So we've started to get more and more deal flow coming our way. We have a great network of kind of referral partners that send us deals. And then we're also actively always combing through the listings on, the usual suspects like SearchFunder and MainShares.
SearchFunder.com, yeah. You also have a couple people I've had on my show, Elliot Holland and Jason Ehrlich, as advisors.
Yeah, that's right. So Jason's Fruition Capital, who are raising a fund as we speak. We have, worked. He's just been a great mentor, both to me and to Nick at the fund. And he supported us with kind of thinking through our kind of investment thesis and process. And he sent us some deals as well. And with Elliot, we recently, it's a bit more fresh, but we've kind of become involved as a deal sourcing type partner. So Elliot will share compelling deals with us as he sees them.
Let's talk about that self-funded searcher, because that's what I come across mostly is people just, they want to own the whole thing. They don't want to be a W-2. They want to own the whole thing. So they're going to go out, look for a business doing $500K, $2 million EBITDA. Is there a specific industry you're looking for that you don't do, that you love, your sweet spot?
Yeah. So kind of the framework that I would say most everything trickles down from is we look for essential products and services, right? So businesses that either manufacture and sell an essential product or provide an essential service. Now that can span across, a litany of end markets. However, we do have some boundaries on those end markets, right? So we do want to avoid end markets that are highly cyclical or highly sensitive to discretionary spend. So for example, taking an easy example, right? A plumbing contractor might be seen as an essential service, but if that plumbing contractor only services, luxury retail stores for whatever reason, all of a sudden we're inherently exposed to luxury retail, which is not a sector we would typically invest in. So that's I would say kind of the way we think about it, right? It's the product and service that the business provides, but also the end markets that it's exposed to.
So let's say they find a essential services business. It's an HVAC company. My recent podcast was the guy that bought 3 HVAC companies. It's doing $750K in EBITDA. It's been around for 20 years. Perfect scenario where the owner is retiring, wants to keep the legacy, and has a reasonable price on that. So he brings you the deal, and where do you come in? I mean, where he's going to, let's say it's a $5 million business, and he's got to raise, it's 10% down with the SBA, 90% loan. Interest rates are going down a little bit. Depends on where you go. I've seen like TD Bank, if it's local, you can get 8.5. So he's got the deal kind of ready, baked in. It's ready. Where do you come in, and what are you looking for that he doesn't have?
Yeah, so the owner doesn't come to us generally. It's the searcher themselves, right? They'll have the LOI, fully baked. Some folks have come to us while they're kind of going through the LOI process and asked us, Sean, is this viable? Do you think we can raise on this? So in certain cases it's earlier than that, but most cases people will come to us, with a baked deal, and they're in that process where they need to raise equity to close a gap to fund the deal, right? They've got, indicative terms from lenders. They know the purchase price. They know kind of what the deal structure is going to look like. Q of E draft 1 or 2 has been done, so they're reasonably confident in, the EBITDA figures and the working capital and all that. So we help, fill that gap. And then, what I do think is sort of differentiated that has been an interesting way for us to get deal flow, and where we do add value above and beyond, plain vanilla capital provider, is we sort of have two value added angles. One, we support with deal sourcing and inorganic growth from an acquisition target perspective. So we do have kind of a proprietary deal sourcing engine that's always on, and we can point it in thematic directions. And it's, a way for us to support, especially searchers who have kind of an inorganic growth strategy. We can help them find leads. And actually, for the deal we closed recently, we've already sent them 3 proprietary leads that are, well aligned with their criteria for a roll up. So that's one really neat way, and one reason people come to us outside of just closing an equity gap. Right. The other one is, as you mentioned, my business partner Nick Bryant. He's a serial entrepreneur. Multiple exits. He's on the software, kind of more technical side of things, and he's building out a tech enablement playbook, which is so key for a lot of people, right? That searchers kind of go into these businesses, look for new economy ways to kind of level up operations, whether it's installing a CRM or, an ERP, or just kind of new tech stack, automation in general. Nick's building out a way, and we've already began kind of supporting folks with those initiatives as sort of call it a center of excellence or value creation center.
Yeah, optimization with old technology. Let me go back to that gap that you help fill. So the guy finds a great business. It's under LOI, reasonable multiple, can handle the debt cash flow. Let's say it's a 2.1 debt service coverage ratio, but he needs, it's $500,000 down. He's got $100,000. He needs $400,000. This is where you come in, right? You can provide the $400,000, but what is that cost of capital to him and to the business? What does that look like?
Yeah, it's a great question. So, I think the common metrics that people throw around are kind of the 30% IRR target, right? And that's coming from the Stanford
stuff, which I think I always push back. I go, look, I understand that you want 30% IRR, but the HVAC business has only been growing at 5 to 7% a year for the last 10 years. So that's a little bit of conflict or friction where that's going to look like at the end of 5 years when you want your money back.
Yeah, especially if you're not, pursuing an exit path, if you're doing more of a long-term hold, kick off cash flows.
Let's tell you one and done. Yeah.
So I think, we do have a cost of capital that sort of, I would say, triangulates towards that range. But really the way we think about things is from a downside standpoint and then an upside standpoint. And that, of course, kind of averages out in a sense to your base case. But we want to see a downside scenario using kind of realistic assumptions that are based on historical, financials, historical performance, and kind of, improved credibility through kind of qualitative factors that we see kind of on a forward-looking standpoint. When we build that downside case, we want to see a return that is kind of in the range of or a bit north of the average S&P 500 return over the past 30 years.
All right, 11%,
right? So,
12,
exactly.
11 to 15%. Yeah.
So something nice that even if the business just stagnates, declines a bit, margins compress, but it pays down the debt, that's the key piece here, right? If it can still pay down the debt and equity holders can increase their position towards the end of a life, then we still see that sort of, nominally attractive return on it for a downside. On the upside, we want to see a credible path to a return that is north of 30%. So that's where you get that 30% kind of, outcome that's very exciting for everyone, right?
Yeah.
Now we know that that's the upside case, right? It's not every single one is going to knock it out of the park, but we look at every deal with that asymmetric return profile to say, hey, if this one does knock it out of the park, it's a 40% or it's a 45%, right? And that might mean the acquirer has to roll up, 2 or 3 more add-ons, or they have to execute flawlessly on a sales strategy, right?
Yeah.
So that when you take those two, go ahead.
What does that look like? Is it participating preferred? Is there a step up? Is they're looking for a coupon? Is that how, if you total that up, is that how you're going to try to get your 30%?
Yeah, it's a mix of all those. So, and it also depends on, I kind of mentioned the 2 personas that we invest in, right? There's the self-funded searcher, there's the independent sponsor. For the self-funded searcher, when there's an SBA loan that they're personally guaranteeing, that's when you see that step up deal structure, right? Because the searcher is being compensated for, personally guaranteeing the loan and taking a substantial amount of personal risk. So yes, we look to see a step up in the range of 2 times on those deals. We look for a preferred dividend in the range of 10 to 15%. And when you kind of put all that together and mix that with the cash flow scenarios I just talked about earlier, that's how you get that kind of downside and upside dynamic.
So when we first connected, you just started the fund. I mean, it just started in 2024, but since we connected and scheduled a podcast, you've actually done a deal. So if you can talk about that deal, anonymize it, but just tell me a little bit more exactly what that looked like and why you chose it.
Yeah, absolutely. So the deal came in, across our desk originally from a co-investor who's in our network who we've now, looked at multiple deals with. So that was a nice show of faith, right? That this individual is investing in the deal. We know they're credible, and that kind of helped kick off the process, right? So we looked at the business. It's a commercial HVAC business based in Toronto. So it's kind of,
So you're not concerned about cross-border investing?
No, not in Canada, no. We've gotten comfortable with, North America in general. So
obviously.
Yeah. So commercial HVAC business in Canada, very classic kind of search deal, right? Very much a necessity business, good end markets, all the kind of things we talked about. In fact, a lot of the details you went through earlier were almost like a premonition of some of what I'm going to say now, down to the specific bank you mentioned.
TD Bank, 8.5% if you're within 200 miles of a retail location. Yes.
Can't comment on the specific cost of debt. But what I will say is, attractive purchase multiple, strong acquirer, healthy EBITDA to the tune of, in a range that provides plenty of kind of cushion in a downside.
20 to 20. A good HVAC business process is 20 to 25%. Did you say it's in there?
On commercial, at least from what we've seen in commercial, it's a bit lower. The 25% range would be a bit high from what we've seen in commercial. But, I have also seen at least in the search space. I have also seen reports that have kind of indicated that figure. I've yet to see it. So maybe I'm a little, naive in this
Well, they
space,
probably won't sell, but if they do
Yeah.
sell, it's going to be a premium.
Yeah, that could be. I guess I should say I've yet to see it and see it in a credible format that, this business is going to sustain a 25% EBITDA margin. You see it.
Yeah.
I've seen a lot of residential HVAC businesses, at least on the, deal reports and the BVR and other kind of sources that are doing substantially higher margins, but commercial seems to be a bit lower from what I've seen.
Interesting. Yeah.
But anyway, just to round it out. So we had lots of conversations with the searchers, got really comfortable that they're, qualified to pursue their strategy. They do have financial backgrounds. They're pursuing an inorganic growth strategy. And like I alluded to, that's an area where we can add value. So that was exciting as well. When we thought about it from that concept of the asymmetric bet, the downside to the business, it's got a really healthy revenue base, strong end markets, lots of recurring revenue. We felt confident that the downside scenario, even in a challenging market, would return above that, that market return. But on the upside, if these folks hit their goals on the inorganic side, especially if we can help them do that and de-risk things a bit, that's a return that's, much higher than I think the cost of capital would justify. So
let me ask you about the people qualified. You said they had financial backgrounds. Do they have any HVAC running a HVAC business or managing people? Because managing trades.
So
you know what they call them in Australia? They call them tradies.
Yeah. So I'd say from they'd spent a good deal of time in the sector and in kind of the search process and learning about the space. So that's what kind of got us comfortable. Certainly had managerial experience in their kind of roles, but I think, it's always a gap and you've got to make that decision. I was just speaking with someone earlier today about, the balance between a group whose skill set and background is really well fit for the strategy they're pursuing versus, an individual or a partnership whose background is squarely aligned with the industry and kind of the cultural dynamics in, the firm they're taking over. And I think it's kind of a balance. And much like building a diversified portfolio, you may think about it as, some opportunities you focus on the one skill set and others you focus on, more generalist, strategic kind of big picture skill set.
Let me ask you about the commercial versus residential. Now, I'm not an expert at this, so I have seen some HVAC businesses in Arizona. Their commercial is, they could own the contracts to a Fry's grocery store or a fast food restaurant with like 3 or 4 locations in here. And what happens is they do have reoccurring revenue, but it's not a large number. It's a nominal month-to-month fee to be available. Because if a freezer goes out or HVAC goes out in Arizona, you got to replace that product real quick. And maybe you buy the entire unit, which is there a spike in revenue, then a drop down the reoccurring. Why is that a good business for you?
So I think you're commenting on kind of the seasonality of the business, or just specifically more on the breakdown type repairs?
The revenue valleys, peaks and valleys of a commercial business. There is reoccurring revenue, but it's because they want you on site and staff if something goes down.
Yeah, so you're kind of distinguishing between the preventative maintenance contracts versus the actual repair work that gets billed and called in. That's what you're talking about. Yeah, I think from what we've seen, the preventative contracts are kind of the foot in the door to then get more of this recurring work that is generally recurring in nature because, these systems, and again, and I'm not an expert in this either, right? I want to preface that and that, just like you said, but, the systems, from my understanding, do have a fairly typical kind of repair cycle, and there's certain things like filter replacements or other types of boiler repairs or what have you that are kind of more frequent in nature, so you can start to rely on those along with the preventative maintenance kind of floor. as recurring revenue, right? What we're
Right.
not focusing on here is a commercial business that is heavily anchored towards install revenue, right? So when there's
Yeah.
new construction, they are the ones installing the HVAC systems. That is not what we're talking about, right? It's a service
They already
business
have the
model.
contracts with large, whether
Yeah.
it's buildings or it's grocery stores or it's food franchises, whatever.
Yeah. Industrial, facilities, big warehouses, things like that.
Yeah. Great. So what is this independent sponsor? Was their goal to say we're going to start rolling up? We understand the difference between the one and done. It's hard to look at something and get a 30% IRR for a one and done than it is a person says, well, we're going to roll it up. And as soon as we get past 10, 15 million EBITDA, we're going to get a bump in multiple. It's going to be a multiple expansion. Is that what they come to you with? Said, this is who we are and what we're trying to do?
Yeah. So, you see lots of kind of roll up plays in the space, and there's always some assumption around multiple expansion and how extreme the amount of multiple expansion will be. And of course, I think for virtually anyone in the space, one of the prevailing strategies is to take a business that's kind of below the radar of middle market private equity, grow it in one way, shape, or form from an EBITDA standpoint, whether that's organic growth, whether it's inorganic growth, or just improving margin. And then, make that business marketable to lower middle market PE, which the assumption then is there's a lot more capital. It's a more efficient market, and that will drive multiples higher. And of course, when EBITDA is higher, it's a less risky business, and maybe operations are better as well. So it's higher multiple. So yes, I'd say virtually every single, investment memo we reviewed has some degree of multiple expansion assumed. We'll generally, we'll always look at scenarios that assume no multiple expansion. And frankly, the most credible approach, at least in our mind, is to go through the BVR data, the tremendous data that also Search Funder, allows access to, which is pretty phenomenal. And you can pull up tons of transactions that are pretty close in size and kind of, margin profile. You can really get in the weeds and look at deals and figure out, well, what is the average purchase multiple, the median purchase multiple, and are we in line with that? Even if we hit, in our forecast year 7, we assume this thing gets to 4 million, 5 million in EBITDA. Okay, let's look at the 4 million, $5 million deals. Where are those multiples? And frankly, a lot of times they're not too far north of where, the deals we're looking at in the 2 million, 3 million. So we generally won't assume much multiple expansion, if any. But in the upside case, like I talked to you about our framework, the upside and the downside, we'll certainly give credit for, maybe a turn and a half, 2 turns if it's a big swing.
I have to tell you about a little story about the BVR and the multiples. I had a conversation with a guest of mine, Adam Coffey. He's been in private equity, and an individual reached out to me. He was buying some businesses in the medical field, and he's done well. He's done about 10 acquisitions so far, and he was seeking at Adam Coffey's kind of interest level as far as investing or provide guidance for future acquisitions to maybe sell to private equity down the road. And Adam basically said, I'm passing, because he showed me some screenshots of business valuation resources multiples on this guy's particular niche. It was too broad. It wasn't niched enough. He said, you're not going to get the multiple expansion you think you are in 5 years, even if you get the EBITDA. So that's pretty illuminating for me. And then when I shared the story with him, it was like, wow, it was difficult. By the way, to understand, hey, he's doing a great job. You're increasing your wealth. You're doing everything great, but it wasn't in his buy box because just not going to get that multiple.
Yeah. No, it's the debate over, whether or not to give credit for multiple expansion is always ongoing, right?
Yeah.
But I think the BVR data is pretty incredible, and for people to have
So let's talk about where this money comes from that you invest in. Is it your own money, or is it outside investors, high net worth individuals, institutional, and do they actually? A lot of people think that never raised money before. Somebody's gonna write you a check, put it in your account, and you kind of spend it. But that's not really how it is. It's more of commitments. So tell us about that.
Right. Yeah. So the largest commitment, we have an anchor commitment from Nick, which is very sizable and a great show of faith from Nick as a GP, right? Who's a co-GP in the fund. I've contributed some capital as well, and then we have a few additional kind of commitments that we've added in. We did so, like you noted, we held our initial close about 4 to 6 weeks ago. We have opened the fund for a second close, so we are taking additional commitments. And I think the main, kind of focus there is twofold. It's folks who are sophisticated investors, PE backgrounds, hedge fund backgrounds, and kind of just broader kind of investing experience that are interested in the sector, want to get involved in a diversified format. And then it's also folks that are really strategic and can add strategic value. As I kind of mentioned, our whole mantra around being a value add investor. If we can bring in LPs that have great sales backgrounds and are interested in kind of taking, a portfolio company or two under their wing and providing that mentorship, that's sort of the sweet spot for the, groups that we're talking to and that we have commitments from.
Yeah. So these LPs, are they familiar with this asset class of investing in down payments for SMB, or is it a completely new conversation?
So, everyone we've talked to, I'd say 90% of people we've talked to are familiar with it and kind of understand the dynamics. More so on the traditional search side of things, which, as we all know, has been around.
Yeah, Armory Partners from Harvard and those guys, that's bigger
right.
EBITDA numbers, yes.
And much more formalized, there's structure around that asset class. There's a lot less structure around the self-funded search and kind of this lower end of, blending with the independent sponsor market. So there's definitely some coaching, and we're doing work to kind of educate and teach people more about how the kind of dynamics of deals look, where we come in, just like the questions you were asking, right? Like what are we actually doing? So certainly folks do ask us those questions.
Yeah, this is tough. I think if you go to them, he goes, well, it is a new asset class for SMB, and a couple things go through their mind, like who else is doing it? What's their success? And what's your deal flow look like? And why are you different? I mean, if I was an investor, I'd be asking some of those questions. So
yeah, no, I think those are kind of the three key points. And on the deal flow side, I'd say we're well covered. We see 20 to 30 deals a month and have been able to be, I'd say, pretty selective. A lot of that's more and more that's coming inbound as we're kind of more vocal about the fund and getting more involved in the community. On the kind of differentiation side, I feel we've built a really differentiated approach, and bringing in kind of some value add angles that are unique to mine and Nick's skill sets are pretty, important to our mission and kind of our investing style. But then kind of the middle question, right? What's the track record? How have you guys kind of done this in the past? I mean, the reality is we're emerging managers in this space, right? We can't lean on track records from different investment classes, right? Nick's done tons of angel investments. He's had some big successes there. I've spent time in venture capital and in leverage finance, but the reality is this is a different asset class. It combines aspects of all of that. So we believe we have a really strong approach and a great view to it, but the reality is we don't have a track record yet in the space. So.
Yeah. Well, the hard thing is, let me give you two connections here. One is I did an interview with a guy that just got out of Harvard, and he was a traditional searcher, and I my first question was like, I don't understand how they're allowing you to buy a $20 million business with absolutely zero experience running a business. And he goes, that's funny. My mother asked me the same question. But the key is like buying an enduringly profitable business. Arbery Partners model is enduringly profitable, like what a monkey can manage, right? You're still a W-2. You're at risk of losing the business if you don't manage it correctly. But it's just putting somebody into that spot that doesn't screw it up and then continues the 5 to 10% growth. Right? I mean, is that the key of finding the right people, of looking for the right, what we would say is like in the Silicon Valley world is like, you're on the right train tracks, right? Just get in front of the train tracks.
So certainly that is a big component of our thesis, right? And it's when you talk about the train tracks, it's the company. We're betting on a really good horse, right? We want to see that the horse can run and it's strong. We want good tailwinds behind it, right? So that's the industry and that's your local market that are growing really nicely. We want risk to be well mitigated through both the acquisition terms and the investment terms that we're investing into. And part of in the acquisition side, a lot of that comes from the purchase multiple, right? Is this truly a value investment? Are we paying a price for this that's below its intrinsic value? And then the entrepreneur we need to have confidence that that individual can keep the lights on, that they are driven and dedicated to what they're doing and qualified, right? Those are kind of three characteristics, but underpinning all that is incentive alignment, right? Because you need to have really well-aligned incentives between investors and the entrepreneur so that everyone's working in the same direction. And when things go bad, everyone does bad. Entrepreneur probably does even worse. And when things go well, the entrepreneur does substantially better and investors walk away really happy, right? So that's kind of a key piece there. It all needs to be underpinned by incentive alignment.
Yeah, let me ask you about the intrinsic value. The searcher, the entrepreneur, has values it at something. The SBA is going to value it at something. Do you run your own value? BVR does it. You can look for comps, and then you do your own valuation. What are you looking for as like a reasonable delta between all of those four that you'll work with and say, I'm going to go, happy to invest in at this price?
Yeah.
Whatever it trades at now.
So, the underwriting something from a lender standpoint, right, hinges a lot around ability to hit interest payments and amortization payments and really service the debt, right? So it's very much a cash flow based kind of focus. We also take a cash flow based focus, and we're very, I would say disciplined about those kind of cash flow scenarios I mentioned to you, especially the upside and the downside and what kind of shakes out in the middle. So, we value things based on what our target IRR is. And if the outputted value is substantial, has a good margin of safety over what the buyer's paying, that's one way we look at it. We look at it using the cost of capital that, we expect in the market, which is to the tune of 25, 30% for equity. And then whatever kind of the cost of debt looks like. And we average that out and run kind of an intrinsic calculation based on discounted cash flows. And then, of course, the relative stuff using BVR and kind of other market metrics, both in kind of the current year and then in the terminal year, is critical, right?
When you find somebody that kind of meets your profile, the buy box, and you're going to go back to your investor and ask for a call for capital, is that another level of like, I got to get approved from them? Or is it's green lighted already because you already signed them up, they're committed on this thesis?
So Nick and I are on the investment committee, and we have, full bandwidth to choose what investments we make. We, have a process where we'll go through kind of this valuation, the quantitative stuff we just talked about, as well as more of a qualitative kind of checklist or scorecard type analysis.
Yeah.
And we'll talk through that together and say, this kind of passes all the red flags. This passes these qualitative checks, but there's kind of a yellow flag here. Can we get comfortable with that? And we'll debate it, and then we'll make the decision on, whether or not we want to pursue a soft commitment and ultimately a commitment to the.
Give me an example of some yellow flags that you look at.
Yeah, so there's some pretty common risks in the space, right? Like customer concentration. Small businesses often have, an outsized portion.
Especially with commercial, right? Residential, you don't have that. Commercial, you do.
That's right. But on the residential side, then you have discretionary concerns, right? If it's a less necessary business, people will tighten the belt, right?
Yeah.
Not
in Arizona. I will remind you, it doesn't happen in Arizona.
That's an A+ market.
Yeah.
But yeah, so take yellow flag and customer concentration, right? We looked at a deal where there was roughly 60% of revenue concentrated between a couple customers, which was very concerning.
Yeah.
However, there were 4 owners in place who would be kind of, all really well incentivized based on a great, deal structure to maintain those relationships. The customers had, 30+ year tenures with the company. And, because of those kind of surrounding factors, risk mitigants baked into the acquisition, as well as long tenures and incentive alignment, again, with the owners, right? We were able to get comfortable that was a yellow, something we got to pay attention to, and that could substantially impact performance. But it's not a red because, it's been well mitigated from our perspective.
Let me present that. Would it go to red if you had these 4 individuals, they ran it for 30 years, they were still going to service it, but it was a year-to-year contract versus a 5-year contract?
It would be closer. I think what would really drive it to red is if there wasn't substantial risk mitigation baked into the acquisition itself, as well as, really long-term relationships. If neither of those 2 things existed, it would probably be cause to pass, right? Because we couldn't be certain that, for example, if this customer came in last year, contributed 30% of revenue, all of a sudden we're buying into a company where EBITDA is inflated by, whatever that 30% of revenue trickles to the bottom line at, that's now a huge risk because we don't know if that customer is going to stick around. There's a 1-year contract. Maybe that's all it is. They needed something for that year and they're running away. Of course, you can diligence that and whatnot, but it's different when you say, hey, this is a customer that has relied on this business for 30 years. There's no indication they're going to stop relying on it. There's no foreseeable disruptions. So it makes it a lot more easy to get comfortable.
Let me ask you about the quality of earnings. Now, I know you have Elliott Holland on staff, but how deep are these QOVs? I mean, QOV for a mid-market or bigger company, you're having conversations with customers and asking how long they're going to stay with this customer. Down lower, it's a little bit less. What are you looking for there?
Sorry, I think I.
Well, like what level of light DD or DD due diligence you do on these quality of earnings? I mean, I'm contrasting if you do a quality of earnings in a larger company, they go to the customers and ask them, how long are you going to be with this customer? How long are you going to keep buying? Because it's a partnership, right? But lower end, it's a little less. And what are you happy with?
So that's certainly, I think, a key, piece of this ecosystem that may be challenging for some folks, but we rely on the acquirer's due diligence process for a lot of this. So of course, we've, run our own reviews of their processes and of the quality of earnings that they're getting done. And we want to see it being done in an unbiased way by a third party, that's reputable, right? But assuming they have all that in place, and I'm talking about quality of earnings, but this applies for other diligence work streams as well, right, that are necessary. They have all that in place, then, we'll review the quality of earnings and determine whether or not it's up to par with our expectations, but we will rely on that, right? So that's, I think, a really critical differentiator, it's a really critical difference in this sort of in market than in, to your point, if you're a PE fund running or in my role when I was doing buy side M&A advisory, right, like you would be retaining PwC for quality of earnings and doing a $200K quality of earnings and going.
Yeah.
Turning over every stone on a $100 million company.
Every stone. And they still miss stuff. Yeah.
Yeah.
Yeah. So where you're at right now, you've got one investment. What is it? What do you need to be kind of happy with what's in your basket? I mean, do you need 5 of these companies, 10, 20? What does that look like?
Yeah. So we've got 2 more soft commitments out there. So we do have kind of rolling closes probably in the next couple weeks and then a month or so after that. And we've got 3 to 5 more in front of us right now that are kind of, I'm confident 1, maybe 2 of them will probably get to that soft commitment stage and then close months after that. So we're doing, call it 1 deal every 6 weeks or so. And we have a 3-year deployment period.
A
So
3-year?
1 deal. Yeah, we do.
That?
So it's
okay.
It's some good flexibility. 36 months starting in August. So we're cutting into it a bit, but we've got, we will have 3 deals under our belt, doing about a deal a month every 6 weeks or so, and looking to get to ideally 25 to 30 companies. We want to have a well-diversified portfolio in the space. And, I'd say a big part of that is because this is a mix between kind of concentrated, LBO style investing and entrepreneurial investing, where having kind of a much broader diversification of idiosyncratic risks is critical.
Yeah. What does it look like at that 3rd year when there's it's time to exit and you're asking the entrepreneur, the buyer, to do what? Like, he's going to look at his balance sheet and go, you know what? I owe search fund investors this amount of money. They want it back.
Yeah.
Plus investment.
So we're not creditors, so we're not going to come, breaking your knees with the collectors. But the point of clarification, we have a 3-year deployment period, which means we have 3 years to invest capital.
That's okay. I got that wrong. Yeah.
But we'll hold our investments for 10 years. The life of the fund is 10 years plus, a 12 months extension. So it could be, an 11-year fund hypothetically.
Oh, so they're not looking for return on, the investor's not looking for a return on investment or return on equity. They're looking for like cash flow or some kind of dividend.
So it's mixed. A lot of people ask, are we going to see cash flow? And I think, we do prioritize deals, I would say, that have nearer term distributions, but it's really, about compounding capital, right? And of course, we're levered to an IRR metric. So the sooner capital comes back, the better. But at the same time, the more we can compound that capital, that's also, something we're incentivized to do. So most of the deals we're looking at have, call it, hold periods between 4 to 7 years, which gives some good comfort within the fund life. Now, no plan survives first contact with the enemy. So we're very well aware that I think a substantial portion of those may trickle longer than 7 years. But that's sort of the profile, right? And would expect most of the distributions to come in that kind of, liquidation event scenario versus dividends and cash flow distributions. Though we do, have dividends in every deal we've committed to so far. So,
gotcha. So you're looking for self-funded searchers, independent sponsors, and investors. Anything else that you need?
Just great collaborators in the space, John.
Yeah. And exposure really helps.
Yeah.
Do 100 more of these and have a couple books, and you'll have unlimited deal flow.
Right.
Well, Sean, appreciate the time you spent with me explaining this, your model, this search fund investor model. I appreciate the time.
Yeah. Thank you so much for having me.